Hey, what's up you guys? Welcome to another episode of Miranda Investings and Financial. Last week I did a video about inflation. I guess it was more about these forced stimulus that they want to propose and want to go ahead and pass. How it was not a good idea not to do it just because of the consequences. If you guys want to check that out, please feel free to go ahead and do so. But today I want to go ahead and talk about beating inflation. So we know about this inflation that keeps on going on. First thing first, I want to go ahead and just define what is inflation. As we could kind of read here, put a kind of little definition that kind of summarize what inflation actually means. It just means a decrease in the purchasing power of money reflected in a general increase in the prices of goods and services in the economy. What does that mean? Is a lot of people have this understanding about how things are getting more expensive, which is not necessarily it, but yes, it kind of has something to do with that. What it really is that your dollar is being devalued. It's not holding its value, so it keeps on decreasing its value. You could kind of say that it's losing purchasing power. I just want to go ahead and just start, guys, is I know that financing for a lot of you guys, or maybe you just don't really care, just don't really think about it. And then every day, I just want to go ahead and just inform people, just to kind of let you know what's going on. Now, it's not the sexiest subject out there. I just feel it's something to talk about and just to kind of let more people be aware. That said, just want to advise you guys that keep on, I'm not a financial advisor or anything like that. I just go ahead and want to go ahead and discuss my opinions on things that probably be best to help people, or what actually has helped me a lot in terms of my family and just kind of savings and using some of these tools to be better off. So once again, due diligence and do your own research when it comes in regards of this kinds of things. Like I said, this is something that I have been using, that's been working for my family. Maybe it might work out for you. I have a different type of lifestyle than you guys, or you guys want to live some certain way. It's really up to you guys. Let's go ahead and just kind of begin. For the purpose of this channel, guys, I want to go ahead and just educate people. I think though that's the very most important thing to do, is to educate people, start thinking more about their financial goals. Second, of course, is one of the biggest thing. It's about making, saving, and investing money. Also note in the way that I want to go ahead and just not just show people, but also there's a way of actually making money, also looking forward to the retirement and all that, to certain ways that also to decrease the risk of losing money. Of course, our goal is, or my goal is, to start making good returns and with minimal risk. Third, my main goal is reaching financial independence, or just having the liberty to leave my job and not worry about being broke. But all jokes aside, guys, I just want to be more flexible in my life and just spend more time with my family and just other things that I love. I think that's pretty much everybody's goal is. And so also one of my biggest key things that I have seen a lot is that, especially in our type of people in the United States, is that retirement age. A lot of people start retiring between like 65 or 67. So who knows, even in our lifetime, it might even be a bigger number. My thing is that hopefully able to return when I'm 50 or 55. So that's my goal. I'm not want to go on to do the 67 or some age. It's just, I think life has been made to enjoy the years, or not to be waiting, just working. But anyhow, that's just my goal is to retire early as well. So when it comes down to inflation, I do have a couple of my friends and family that will ask me, hey, what's the age that I should be retiring, or what would be the good age, or how do I set money? And I ask them, hey, that's a very good question. So what you can actually do is to look into something that's called FIRE. It's called Financial Independence Retire Early. It's a very simple calculation, guys, but I'm just going to go ahead and give you. Gain all your expenses, all your monthly expenses. Let's say if you happen to have, I don't know, $1,000 of expenses. Just go ahead and add that up, times it by 12, because of course there's 12 months out of the year, and times it by 25. That's your FIRE number. That's basically the number what you want to get at to start retiring, and to kind of give you a good feel of the max number what you need that to have in terms of money in the stock market. I see this could be a little bit controversial. I've seen this number kind of changes, but the thing is that it's called a 4% rule. And this is something that you want to keep on withdrawing money from your savings, or also from your pensions. But it could go and say between 4 to 5%, or even 5.5%. The thing is that when you basically taking out this money, this is something that your money will still keep on sustaining itself, still able to basically still stay invested in the stock market while your money still grows, while you're retiring, so on and so forth. If you happen to go ahead and increase that withdrawing number, of course, let's say if you one day wanted to blow it off like 6%, the money that you're actually withdrawing, any money that you happen to have on the stock market will of course run down much more faster, which will give you less years on your pension or also your retirement. So you don't want to basically be working, let's say you're 90 years old and your money just runs out. You don't want to actually be running out of money when you actually are 90 years old. Just keep that in mind. So between 4 to 5.5% of withdrawal money is kind of best thing to know. But keep in mind, guys, I just want to go ahead and just note this as well, that when you're looking at the retirement, you also have to consider, keep in mind, you also have to consider the inflation, calculating kind of like the I want to say like the worst case scenario, but just something for yourself to put in mind. Like, hey, if inflation is being about 3.5% or average 2.5%, most likely will be more like 3%. You have to go ahead and calculate that in your retirement because yeah, I mean, in the future things are just going to get more expensive as our dollar keeps on devaluing. Unfortunately, you know, it's gonna be a little bit too, or it's actually quite difficult to actually calculate, but it's actually the best thing to actually add inflation, you know, throughout the years, just kind of 3%. So you might be asking, it's like, all right, so how do I actually go about doing that? So let's say, guys, let's say if you actually are investing in the stock market. So in the stock market, you are making an average. This is like the S&P 500. This is basically an index fund. That it's a basket of stocks that are just in one basket. It's actually self-managed, and it's just more of a passive investment. I'll go ahead and explain to this more in later videos, and just kind of explain what it is and what's the index that I kind of invest, or what kind of index funds to actually look out for to invest, because not all index funds are the same. Also, different costs have to consider. Just something to keep in mind. But as of right now, for the past 50 years, guys, so the index, the S&P 500, as you could tell here from my charts, that it has been returning an average of 10.9 to even 10 to 10.9% in returns. That's for 50 years. Of course, you know, as you could tell right here, that even between 2001, this is a dot-com bubble, in 2008, that of course we had the home market mortgage crash, and we've seen maybe about 50% of our stocks go down. Keep in mind, of course, it goes up, it goes down, goes up, goes down, and ever since 2011 through 13 has just been going outstandingly high. Of course, we had the March 2020 due to the pandemic, and has went down about 30% and has regained back to just breaking a record number. So I don't see this kind of going down anytime soon, but don't hold me to it. Things will always happen. It probably will go for, I don't know, a few months, a year, who knows. Like I said, you never know. Anyhow, going back to this, you know, the percentage has been about, for 50 years, has been about 10 to 10.9% in terms of growing. So what does that mean? What does that tell you? So it's been compounding. For the past 50 years, it's giving you almost 10% a year of interest. When it compounds, it just keeps on accumulating. It just keeps on accumulating. It just keeps on growing your number. We'll just kind of give a little quick example here for our investor.gov. It just kind of shows you what compound interest. Let's just do it for right now, guys. So let's say if you happen to go ahead and invest $1,000, okay? And then you end up putting $100 like every month for the length for 5 years. So we're just going here from 2021 to 2026. So let's say our estimated average interest rate, it is 10%. That's what's getting returned. And also interest rate variance, guys, that's just kind of like a range between, okay, it could go up 4% more, 4% less. So for example, we have an average of estimated of annual interest rate is 10, but the variance range, it could be 14%, or we could put 6%. So when we calculate that, guys, and I know I kind of calculated before starting this video, but as you could tell, that our money has rose within the 5 years. And let's say like it was a good time in the stock market. The stock market still keeps on going up, still getting that high breaking returns and all that. In 5 years, say if you invested that, you'd be getting about $9,857.54. Your average, your 10%, you'd be getting about $8,936.63. And of course, when you go to the 6% below, you're below variance of 4%, that's only 6% return. That's $8,102.74. But then again, too, we have to keep in mind, guys, for the past 50 years, inflation has been 3.5%. We have to have to account. Let's just say that for rounding off purposes, just for simplicity, okay, just for simplicity, we're going to go ahead and just round it off to 10% of the index, returning your money every year, compounding 10% every year. Now let's get into the inflation. So inflation, it's going to be about 7%. In reality, you're actually getting 7% on return, which is still not that bad. If we actually go back to our investment, 7%, so we're probably looking between above that 6% and 7%, we're probably looking between, I don't know, maybe about 8,200 or even 8,000 at the most, 300. But still, that 1% is still quite a few. It's better than 0.01%, what your bank is paying you, which is, you know, as you kind of figured by now, you actually are losing money every single year. Just keep in mind, guys, like last month on June, the time of the recording, our inflation for that month only was 5%. So keep in mind on that. Go ahead and move to the next one, guys. I'm going to go ahead and discuss a little bit how you're able to go ahead and combat inflation. Keep in mind, guys, that this is just my opinion. Of course, some of these things I'm already actually using, or I actually have researched quite a few, put some hours and time. Okay, so let's go ahead and start with number one. As you've had guessed it, guys, as I was talking earlier, investing. Investing in, and I'm talking about like good companies, or even if you're not into the researching and all that kind of good stuff, which is nothing wrong, which is okay, and just these things are just passive. Of course, it's just investing in a good index fund with low cost index funds. But also too, you have to be very careful where you actually put your money. So you have to have a good plan, a smart plan to allocate where you actually be investing in your portfolio. Nothing too crazy, you know, nothing like I don't know, like those Reddit guys, you know, to the moon, AMCs and all that. So that's just pretty risky for me, I guess. But anyhow, other things too is just kind of investing in bonds. So why not bonds right now? So bonds is actually going returning a very slow interest rate amount, or even going to the negative. So this is actually a chart since back 2020, but as of right now, the interest is kind of giving like a negative return for the treasury. So that's kind of like the government, and just kind of holding bonds is not the best idea right now, just because if you happen to go ahead and put bonds, most likely the interest rates has to be into the negative. And as I've been researching, is at that -1%. So just be careful, guys. It's best to stay invested in terms of long term, to stay invested 100% in the stock market. Once again, this is my opinion. You guys don't have to take my word for it, but it's just in history. If you got 100%, especially if you want to start that FIRE retirement early, 100% in the stocks, and of course even index funds, a basket just passively has shown that in history it's actually better return and better than bonds, because bonds, it could go different ways, guys, and even at that 50 years it could go to -1%, even 3-4% yield. Yield is what the interest is paying, or even the compound. Also, it is just not as high. Just investing carefully on a low cost index fund. So just want to go ahead and bring that out there. And you guys might be asking, hey, well, how about if I don't have money for low index funds, or like a mutual fund or anything like that, which I'll go ahead and discuss. But as of right now, like, let's say, like, one of my suggestions too, if you want to start investing in like in a low investing funds, just keep in mind there's actually ETFs. It's called an exchange traded fund. As two examples right now, one of the two biggest ones that I like, but once again, this does not mean for you guys to actually go ahead and get it right now, go by my suggestion, but this is ones that I have used, or actually still have, but of course do your research on which index funds or so. But But anyway, let's go ahead and continue, guys. The ones are two that like VU and SPY. So VU is it's from Vanguard. It's also it's a S&P 500 for the 500 index or 500 companies. So it's like an index fund. It's a basket of companies. And also SPY, it's one of them too. And also keep in mind these guys have a very low cost. But I'm not telling you to go ahead and invest in ETFs. You know, it's actually a good place to kind of start looking. Also a low cost mutual fund, which I'll go ahead and discuss in a future video. So I just want to give you guys just a heads up, like where index funds, just an average, just kind of put money in a monthly basis and just watch your money grow. And yes, the thing is that as soon as that, you have to be very disciplined, guys, because the thing is that as soon as you start seeing your money go down 50%, 30%, a lot of people, that's what the biggest problem is. A lot of people, and it's more of a money psychology, that people start withdrawing for the money. They just take it out. And the thing is that as Warren Buffett says, just don't lose money. You know, there's two rules in investing. First, don't lose money. Second, don't forget rule number one. I know it's just kind of a little crazy kind of joke, but I mean, all seriousness, guys, it's one of the things. As soon as you start seeing your money go 30, 40, 50%, and you start taking your money with the loss, you know, that's when you really start losing. That's when you literally got defeated. The best thing is that when companies, let's say like a good index funds, drops 30, 40%, as Warren Buffett says, and it's one of his biggest famous quote. I guess it goes about be greedy when others are fearful, and be fearful when others are greedy. So that means is that, let's say if it goes 50%, everybody's withdrawing the money, and you just keep on buying in, because it, like I said, 50 years ago, guys, the average has been between 10 to 10.9% on your average return. As long as you're able to go ahead and just keep on investing, just keep on your money in there, you'll be okay. And also, a lot of people like to time the market. It's not best to time the market. My biggest suggestion, this is something I have been using, it's called dollar cost averaging. And it's something I was kind of put earlier, just put like $100, you know, $100 every month, and just dollar cost average, and things will start even out. But of course, it's all up to you what you want to go ahead and put in terms of monthly funds. Just be careful on that, guys. So let's go ahead into the next one here. Okay, now moving to the second one, guys. Of course, stop keeping money, high amounts of money in your standard savings account. As once again, I said earlier, they return about 0.01% of your money, so which is peanuts. It's just nothing. Matter of fact, if inflation, you know, doesn't take too much to figure this out, if you getting from your bank account 0.01%, which is inflation now, it's about average 3.5%. Yeah, you're still 3.4% underneath, so, or 4.9% underneath, so which is not good. You actually are losing money. Once again, let's say if you happen to have $10,000 in your account, just, or even, let's just simplicity terms, so let's say if you have $100, so each month you are losing $3 in terms of value of your money. So it's never a good idea. But then again, this does not mean to still have a good cushion for your funds in case of emergency, or even still something unexpected happens. This is just my opinion. I recommend at least keeping about 6 months. Maybe you don't need 6 months. Maybe you need about 3-4 months. But also that just depends of your living, your cost of living. Some people have lower cost of living. Some people have higher cost of living. So when I mean by higher, people might have a high mortgage, car payments, and all that kind of stuff they have to. So maybe they need about that 6 months until they start coming up with a job or working or something, or even pay for an emergency. So I just want to let you guys know that, you know, just in case, keep something. So you never know when you lose your job, medical, or just any type of emergencies. Of course, how to figure it out, just put in your monthly expenses and just times by 6, or whichever months you happen to need it. Maybe 3 or 4 months might be key for you. You're able to go ahead and bounce back on your feet. But that's just my suggestion. As I explained earlier, of course, I kind of recapped what I just said, so I'll go ahead and just skip this one the next time, guys. But once again, this was just an example of, let's say if you happen to have $100, there's a 5% inflation, you already lost $5. So this is something that I already explained earlier, so I'm just gonna go ahead and just move on. All right, let's go to jump to the third one. So now you'd be asking, okay, well, where can I put my money? It doesn't really get inflation besides the stock market, I guess, or the stocks or index funds. Okay, cool. One of the things is that this is something that I have not used, but it's something that I've been researching and reading about. And that's how a lot of the multimillionaires companies or put their money. This is called Treasury Inflation Protected Securities, so short-term abbreviation TIPS. This is the U.S. government's guaranteeing you that they're going to go ahead and keep pace with the rate of inflation. Your money does not devalue over time. One of the things is that the downside about it is, of course, if you happen to put like a 10-year, 20 years. So let's say if we actually happen to get out of inflation, now your money's kind of losing its value there. So it's one of the things you just kind of need to be careful, especially like right now, like I was telling you guys about the 30-year yield, or even the yield from the Treasury. Like as you could tell, even from 2016 to all the way 2021, the interest rate, or even for investing in bonds, it's probably to the negative. So as you could tell, just here by the bottom. So probably that's one of the reasons going back, it's probably not a good idea. But then again, if you start investing in treasuries and tips and all that, it will somehow start catching up with the with inflation. But then again, guys, it all depends how the Treasury Department takes this and what's the interest rates, even if they set it up. This is definitely a due diligence, do your research on this if you decide to go ahead and put it. But I have read and researched that there's a lot of people that actually do put that and does help them. But that's just another alternative. But once again, just kind of research it just in case. All right. So another alternative, guys, is just putting your money in CDs. So certified deposits are something in your bank. But once again, certification deposits don't actually pay as much. They probably go up to like 1%, because a lot of these CDs, they have to go based on what the Treasury, the Treasury Department, in terms of how much money the bank is ever borrowed from the Treasury. Maybe it could be 1%, but they still don't have as much as a high interest. There actually are other banks. Is called a direct savings account. Also, direct savings account, guys, they don't have as much high interest rate either. Maybe CDs right now are usually, well, probably around that, maybe about like a 0.25% or maybe 0.5. But let's say if it wasn't for past all this pandemic, they were probably giving about like 1.5%. But there was also now CDs are probably, like I said, 0.25%. Now with a direct, there's also an alternative. It's called a direct savings account. These direct savings account are basically, they pay like a better high interest rate, and also you're able to go ahead and take off your money. Something about CDs though, that when you put on CDs, there's a time that you have to go ahead and leave it there. So let's say you want your CD for like a year or 2 years, so you're not able to go ahead and touch that money for those 2-year period. But also for a direct savings account, you have more accessible for your money to go ahead and to withdraw. Of course, direct savings accounts don't have as much of a high interest rate. I think they're still right now going between probably the highest one that I've seen, probably around 0.55%, which is still not bad. But of course, inflation is 3.5%, but 0.55%, it's still not a very good. But hey, that's something I suggest that's something in case to leave your money in if you happen to need money to leave in your savings account for in case of an emergency or anything like that. Instead of getting from your savings account 0.01%, at least get 0.55 or 0.45%. At least you're getting something out of your money, so at least it does not hurt as much. But you still hurt, but doesn't hurt as much. So just something, an alternative, guys. All right, guys. So the fourth one, it's gonna be shrinkflation. I know it's kind of funny, especially we got the guy over here that with his ice cream. As you can tell, it's kind of been decreasing over time, and I guess he's not very happy about that. What is shrinkflation? Shrinkflation is that, as you could tell by the pictures, I was saying, yeah, the guy here with his ice cream, things are getting smaller and smaller. Just to kind of define, is that practice of reducing the size of a product while maintaining its sticker price. It still costs the same. Let's say you buy ice cream, it still costs the same, but as this gentleman right here, the quantity just keeps on reducing and just keeps on reducing and just keeps on reducing. One of the things is that kind of other like sodas, for example, Coca-Cola, and it's one of the companies big companies, well-known companies, of course, is in terms of beverages or major soda companies, that they used to give 2 liters, just buying normal price. I don't know what's the price right now of 2 liters, but it used to be 2 liters. So now they actually happen to reduce it for 1.7 liters. Again, the reason for this is because inflation, the companies, they get impacted by it too. And so they have to reduce the quantity, and they just can't, especially now it's a lot of things are high in demand. So of course you might not see the high prices, but then again, there's one way they might get you is by reducing. And that's also comes with ice cream or even other type of products you happen to buy, or even chicken or any other things that, of course, it might cost the same, but you just get less of it. And that comes with water or anything, or even candy bars that I have seen, or for this case, our guy right here with the ice cream. Two little ways just to kind of combat this inflation. So you might be asking, so how do we combat this shrinkflation? One of the things is that a lot of people, a lot of consumers, including myself, that I've seen is that I look at the price. But the thing is that we want to go ahead and just look at the net weight and quantity when buying something. So let's say, for example, we just gotta make sure, as I was giving you the example before, you look at the price, but also you have to look at the quantity of it. And if the quantity is, you kind of notice that there's been, shrinkage, that kind of tells you, it's like, hey, maybe I should start looking for something else. And that brings her to number two. Any other like market, they have brand name products, and that's kind of one of the things is that a lot of these brand name products, mostly, like let's say again, going to Coca-Cola, ice creams or anything like that, that will definitely be more likely to reduce, because of course they're brand name products. A lot of people are more tend to buy them. Of course, there's actually the alternative, just buying like just kind of, for example, Walmart, they have the I guess it's kind of like the good value, and just buy them. It's some things is you probably even get more out of your buck, and this is some way that will help you to fight this shrinkflation and the cost and all that, to put more money in your pocket versus taking more money out. All right, so this brings me to our fifth one, guys, is secure, stable housing. What do I mean by that? As we could tell, of course, now lately the prices have been going up and keep on going up. And most likely the Federal Reserve does not know when this actually going to be ending. In terms of the inflation, it could be another couple more years. Don't want to scare you guys or anything like that, but we might see a little bit more prices still keep on going up. Hopefully not, but you never know. But of course, it's always best to be prepared just in case if something like that happens to occur. Of course, guys, when it comes down to secure, stable housing, of course, owning real estate is probably the best hedge to beating inflation. Of course, let's say if you happen to own a property and you happen to rent that property, is that you're able to go ahead and raise the prices what the inflation, or how much inflation, of course, it's going. And one thing just to know, guys, is that it's not about sounding greedy or anything like that, but even as a landlord, that has to still pay the cost of taxes if things keeps on going up. Unfortunately, yes, the people that will be paying for that will be the tenant that's currently living in your rental property. So of course, I'm just saying, guys, is that towards inflation, hedge to against inflation, it's best just to own real estate. And also you can also raise rents, but of course not to sound greedy or anything like that, but obviously there's going to be someone that has to pay for the taxes, and that's going to be the landlord. And things keeps on going up, guys. It's one of the things is that of course they have to raise rents. You might be asking yourself, well, hey Tony, I don't actually have money to buy myself a house right now, especially house prices are going up. That's cool. There's actually another thing that's actually called REITs. So REITs, it's another way to invest. It's just more like a real estate investment. Let's say if you happen to go and buy into REITs, those guys will invest like in, let's say, commercial rental properties. And also that's another way to kind of get yourself introduced, and also in the real estate, and also will compound and still get some earnings, and also will grow over time because of the real estate. So just something to kind of look into it. Of course, I'll be more than happy to explain more if you guys are even interested. I'll be more happy to get more deep into it. But other than that, REITs is probably the alternative. And also too, guys, so let's say if you actually are the one who's actually renting home or a house, just want to keep in mind, guys, there actually are few areas that have some rent ordinance. So what does that mean is that there's places in the city or state, or the state and city, that will have some regulations that landlords cannot be raising high substantial costs towards their tenant. So that's probably another thing to kind of look into, guys. Maybe, you know, research and see which one. Maybe there's some in a county somewhere that, hey, landlords cannot raise rents on you, so it just kind of helps out, especially for a tenant, because I know there's a lot of family out there that they just can't afford a lot of these rents going up, and they're barely even making it by. Just kind of do some research. And also another alternative is if it's, you know, if you're living in a high cost of living area, expensive city area, or even just a little bit outside, of course houses is going to be pretty expensive. Even if you're actually even flexible to actually move out, you know, to a cheaper state or so, or even just another town or area, you know, that'd probably be the best way how to do it. Just kind of move out. Of course, you know, you do have family to include, you know, yourself, job, and all that. But the thing is that if things are going to get costs or getting expensive, most likely they're going to be getting expensive over time. So maybe, like I said, if you're flexible, just move to a different area, different state or town. So hey guys, so we actually made it to the last one, which is pretty obvious, but I'll put it as a bonus, which is going to be budget, 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 budget. You know, a lot of people don't like budgeting, or just basically don't even care about budgeting, but I think it's one of the more basic and the core area to actually look into your budgets, because you never know where your money's actually going. And I have seen, as I work in financing for almost 10 years, that you see people make six figures. I even seen people make up to 8. And yeah, I mean, those guys are likely to file bankruptcy if you don't have that financial mindset and educating yourself, or even budgeting. You don't really know where your money's going. It's just going on things that you don't need, versus that you can actually use that money to grow wealth, higher wealth. And once again, money comes and goes quickly, guys. So the best thing, just budget yourself, and the way you're going to budget, just kind of look at your bank account statements, look into the monthly, see where you're spending at, and also it gets you prepared and gives you a good idea where you can actually look at to save for retirement, see how your habits are, what you need. So it gives you a good perspective, kind of way to kind of start looking at, okay, I need to start saving this, maybe I need this amount to start retiring, put more money on. Again, budget, budget, budget. That's my key there. So anyways, guys, I just want to thank you again for checking my video out. That concludes this video. I know it's kind of a little bit extended, but I know it's a lot of information, and also want to let you guys know that there's some ways to, you know, beat inflation and just kind of taking it easy, being safe and all that. So hopefully you found a little bit of knowledge. I'm still going to go ahead and keep on with these educational or even just kind of hint videos. So I hope you guys like it. Give me a good like, or if you guys want to comment, if you guys want to hear something you want to know for next videos, please just comment below. And I'll be more than happy to reach out for you guys. And once again, thank you very much.